Today, I'm going to be talking a little bit about how you can plan for profitability on your farm and what exactly the steps for doing that planning and analyzing what you've done in the past. Today's talk is called Small Farm Profitability, but in reality, I want you to think of it as how you can take everything you're doing out in the field and bring it back inside your business center so that way you can do proper planning and proper analyzing. So the first thing that you need to do in any time that you're planning out your farm business is going to be proper record keeping. And there's a few reasons of why exactly we do record keeping, but the number one thing is going to be that so that you can understand what exactly is involved in the production for your farm. And taking that back and being able to assign it to how much you are spending on each specific enterprise. And whenever I talk about enterprises, what I'm really meaning is the different types of farming that you're doing within the entirety of your farm. So if you are doing some livestock as well as a fruit and vegetable gardening, those would be two separate enterprises. And you can even get as specific as within your vegetable garden, you might have a tomato enterprise, a cucumber enterprise, a squash enterprise, and you can just think outside of the box onto that. So whenever we're keeping records, we're wanting to keep them specific to the different enterprises that we have onto the farm. We're wanting to do different categories that rely on our expenses first and foremost, but our revenues as well. And we're going to talk about a couple of different type of record keeping systems. So the first one of those record keeping systems is going to be your financial records. So whenever we're looking at financial records, it's exactly what it sounds like. Is I went to the store, I went to the co-op, tractor supply company, feed store, seed store, whatever it might be, and I spent money on something that I need to bring back to my farm in order to make my operation successful. So your financial records are going to be where you are actually scanning your bank account and categorizing the different things that you're spending money on and how it relates to your farm and to those different enterprises. The other one is going to be your production record keeping system. So your production records are going to be what you are actually doing out in the field. Today I sprayed for pests or for different plants that are invading my vegetable patch, right? Today I worked the cattle and did cuts, fed hay, whatever that might be. How many bales of hay am I feeding during a certain winter? What day did calf number 23 have either a bull or a heifer calf during my calving season? And so the way that those two systems are going to come together are really going to make a difference in how you can plan for next year and evaluate how you did this past year. So what exactly do you need for your financial record keeping system? Well, first and foremost, you're going to need to know when did it happen. So you're going to need to record the date of any type of transaction. Secondly, you're going to need to know who exactly it is that you paid and how much it is that you paid them, right? Or who paid you if it's a time for you to sell things at the market. What exactly was it that you purchased, or what exactly was it that you sold, and who was it to, or who did you purchase it from? The last thing you're going to need to know is what enterprise did you do this for? So did I buy feed for my cattle? Did I buy fertilizer for my vegetable garden, and different things like that? So when you put all of that together, you're going to know when it was that I purchased something, how much I spent on it, who did I pay, and which enterprise specifically was it for. So when we're talking about how exactly I'm going to keep records, there's going to be a few different what I'll call levels of methods of record keeping. The first is one that I would say 90% of farmers that I work with are doing. So it's listed here as the shoebox method, but I often call it the kitchen drawer method. So you have a little bit that you open up the junk drawer in the kitchen and there's some receipts stuck into there. If you look in the mail slot, whenever you come into the kitchen, there'll be some there. There'll be some in the console of the truck. And then there's a lot that have made it to the record keeping system of the trash can and gone to the dump. So if you're someone that is trying to get a handle on things and you've been farming for a few years and you know that your record keeping system has been amiss, to say the least, you are in the wide majority of farmers out there. And so if we can take the next step, So just starting to write things down in a notebook or on your computer, then I would say you're going to be in the top 10% of farmers with record keeping. And that's just the first goal to be attained to. And once you get a little bit more of a sense of what you're doing and what you're spending money on and what exactly works for you in terms of record keeping, if you can then take that and transfer it to something as simple as an Excel or a Google Sheets file, then you are really starting to be able to do something that you can go back and manage and measure what you did for the past year. And then finally, one of the last steps are up there on record keeping would to be actually use a designated record keeping software. One of the most popular record keeping softwares out there is QuickBooks, but I would say for most farmers, so for 99.9% of farmers, they don't need something that in depth. And on top of that, it can be very expensive too, versus there's other record keeping systems out there. So you might have heard of one called Quicken or Ambrook Research or many other types of record keeping systems out there. They're going to be much more cost effective, very easy for you to learn how to use and keep very detailed records without having to put in hours and hours every week. So the point of us keeping these financial records is going to be so that at the end of the year, or even planning out for the year, we can build a few financial statements as they relate to our farm. And the main three ones that you're going to be building are your balance sheet, your statement of cash flows, and your income statement, also sometimes called a profit and loss statement. So the first one that you should be doing at the beginning or the end of each year is called the balance sheet. And when we're talking about a balance sheet, we're really looking at a snapshot of your financials in time. This is going to be something that you do once a year so that you can see exactly how much you own and how much you owe, all to equal your net equity. And so right here, I have an example of a balance sheet, and this is something that you can actually do yourself. So if you go to the link that is provided on this slide, you can actually go in and create a balance sheet that looks exactly like this one, formatted exactly the same, and it'll prompt you with questions in order to do that. So FinPack is a program that I use and pay for, but the free version can actually create a balance sheet for yourself. And if we dive in and look at what exactly is on this balance sheet, you'll see that it's broken down into a few different sections. So the top one is going to be your current assets and your current liabilities. And this is really going to make a difference in your production system for the upcoming year. So our current assets are what we call our cash and cash equivalences, or things on your farm that are going to turn over and be used up within your production system within the next calendar year. And concurrently, your current liabilities are going to be the principal and interest that you've accrued and will owe over the next 12 months. And so with that, we can draw a few conclusions to how our farm is looking at the moment that we create our balance sheet. So the first one is going to be your working capital. So this one is a pretty simple one to calculate. If you take your current assets and subtract out your current liabilities, you're going to end up with essentially the pot of money that you have left over to operate within the year after any loans have been paid off for that year. And similar to it, and a good measurement to see, how good my financial standing is for my farm as itself, or how much money I might need to put into my starting farm business this upcoming year, is going to be a current ratio, sometimes called a quick ratio. And so you're going to take your current assets and divide it by your current liabilities to get a number that can give you an idea of how you're doing. Anytime that this number is over 1, it says that you have essentially enough cash and cash equivalents to pay off your debts in this upcoming year. But really, we want this number to be more around the 1.5 range in order for us to say, okay, we're doing well on our farm this year, and so we can look at possibly expanding into other enterprises or maybe even taking on new debts and that sort of thing. If it is below 1, we're going to say, okay, I need to stop. I'm probably going to have to put money into my farm operation this year, and I probably should not take on new liabilities or new debts. And then if it's over 3, I really should be looking at possibly enterprise expansion, starting to look at if I'm in this stage of my farm management transition, or maybe even taking on some new debts in order to expand, buy a new piece of property, some new equipment, new structures on my property. And so the other sections of the balance sheet you're going to see are the intermediate assets and the long-term assets, and the intermediate liabilities and the long-term liabilities. And I put these all together and just call them non-current liabilities. So whereas our current assets and current liabilities kind of said what we're doing on our farm and the day-to-day operations over the next year, our non-current assets and liabilities give us a snapshot of the farm as its structure is tamed. So if we think of it like a building, the non-current assets are going to be the actual structure, the bones of the house, whereas the current assets and current liabilities are kind of what's in there, the fixtures, right? Something that can turn over fast. So if you take away or add to our non-current assets and liabilities, you are directly affecting the ability to produce for that upcoming year. And the example that I always give with that is that if I have 50 mama cows on my farm, I have the ability to have 50 calves that year. Versus if I were to sell one of those cows, I no longer have the ability to have 50 calves that upcoming year. So I've directly affected my ability to produce and how I produce in that year. Similarly to having a tractor versus selling a tractor versus purchasing a new piece of equipment. You can see how it affects your production as far as the tools that you have in the toolbox and what's holding up your farm over that year. So similar to our current assets and liabilities having ratios that told us how we perform for ourselves, we can use our a couple of other ratios to see how exactly a lender would look at it. And so the biggest one for this is going to be our debt to asset ratio. So if you take our total debts and divide it by our total assets, you're going to get a number that's going to tell someone that you're trying to obtain capital from exactly how big of a risk that you are. So if you're around the 40% or 0.4 mark, it's saying that your current operation is looking good. There's probably no reason to take on new debts, but also that you're in good financial standing and ability to pay off your current debts. If it is above 60% or 0.6, that is a red flag. So 60% of your assets are owned by a lending institution and you should not take on new liabilities. Or if it is below a 30% or 0.3, then you are a good person to lend out money to because you have the ability and the collateral to pay off debts. With all of that putting together, you can really start to assess, should I take on more debt in order for me to expand my farming operation or take on an operating loan, and where exactly should I look to that? So there are some traditional lenders out there that provide agricultural credit, farm credit, river valley rural credit systems are out there that can do that sort of thing. There's also some public entities to do that. So the Farm Service Agency is going to be chief among them for rural farm loans. But then also there's some other things that you might think about. An operating line of credit can be a good way to move your farm along. But then I also get a lot of questions about, should I have a farm credit card? And generally my answer to that is going to be yes, if you can completely pay it off before interest hits after 30 days on that. So a credit card can be a good way to have a 30-day operating line of credit as long as you know yourself good enough to say that I can pay it off completely at the end of the 30-day term. If you cannot, I generally say to avoid it, but also that you also can attain points, which can both help your farming operation or even have some things for you or your family to do something fun with at the end of the year. The next financial statement we're going to look at is going to be the one that you are most centered on, and that's going to be your income statement, sometimes called a profit and loss statement. And where a balance sheet was a snapshot of your farm at a specific point in time, your income statement is going to be something that you're going to do throughout the year in order to see and measure how your profitability is at different points in time. So the first part of that is going to be relatively easy to think through. How much money was I paid during that current year? And you can see a few lines here of different things that you might receive in income throughout a calendar year. But there might be some things that you don't think of that do not go in the revenue side of your income statement. So whenever we think back to that balance sheet, we were split between our current assets and our non-current assets. Well, the current assets are going to be anything that's being sold from that section are going to go on your income statement. But anything from that non-current asset section is probably not going to go on there. And what exactly I mean by that is that anything that you have a loan out on that is a capital asset on your farm that you're doing depreciation schedules for is going to be something that you're going to want to include as part of that balance sheet, have on depreciation schedule, but it's not going to go on the income statement. So anytime you sell your tractor, that's not a regular income that you're going to have year over year. So we don't consider it part of our income statement. Selling breeding livestock falls underneath that. And then obviously any type of off-farm income is not going to go onto the income statement for the farm specifically. Additionally, if you receive an operating loan and that's money that comes into your bank account before you spend it, that's not going to be something that we're going to consider as farm revenue. So the other side of the income statement, and something that makes it extremely important to keep a good record-keeping system for, is the much longer lists of expenses that go along for your farm. And so this is also fairly self-explanatory. Whenever you're spending money, you're going to put it onto the expenses. And so revenue minus expenses equals that net profit. But there are also going to be some things that don't go underneath the expense category, similarly to there weren't things that went underneath the revenue category. And it can pretty much be a mirror image of what we talked about before. So just like you don't have the sale of equipment going in your revenue, you don't have the purchase of equipment, or at least the principal purchase of equipment. They're going to go into your expenses. Things like your interest payments on any type of loans that you're taking out are an expense, but the principal side of it is not going to be an expense. And I know that that seems like it can be a hard thing to keep track of, but anytime that you are making a payment towards a lending institution, they are required to tell you in some form or fashion how much of your money went to your principal and how much of your money went to your interest. So take that interest, put it into the expense category, take the principal, and just realize that you are building the net worth on your farm by having that payment put out there. Now, another side of things, and the reason that we don't put sale of equipment in the revenue or expense side, is going to be depreciation. So this is a non-cash expense that is going to go on your income statement, on your profit and loss statement each year. And my best recommendation for keeping up with how much depreciation expense you have every year is to have an accountant that you can trust and that can look at your assets, what depreciation schedule they fall on, and tell you the amount of depreciation that you are taking out every year at roughly tax time. So this can be an expense that you can keep up with all at one time every year as a general matter. The last financial statement we're going to look at is going to be what's called the statement of cash flows. And the number one thing that I want to tell people is this is not the same thing as profit, but it does make a really important difference of what you can do in your farm every single year, because without the cash flow, you don't know how much money you can expect to be in the bank account at the beginning of the year versus the end of the year. So profit is great, but every single time that I have to pay my electric bill, I have to pay them in cash. So even if I have profit on paper, but I don't have the cash in the bank account to back it up, that can be an issue for my business. And so this statement of cash flow is going to be broken down between three chief sections. So the first one is going to be cash from operations. So my operating cash flow is exactly what my business is designed to do. So if I'm in the business of selling cut flowers, whenever I sell cut flowers, that's going to be a positive for my operating cash flow. And whenever I buy, say, the seed, the fertilizer, or any other inputs that go into that cut flower operation, that is going to be a negative for my cash flow from operating expenses. The second section is in cash flow from investing. And this does not mean that you are taking money that you have in your farm bank account and going out and putting it into the stock market. This is the capital assets that you are purchasing for your farm business. So if we use the example of a cut flower operation, if I am buying a high tunnel, a depreciable asset for my farming operation, that purchase of the asset is going to be a negative cash flow in the investment side of my statement of cash flow. Versus if I were to sell a piece of equipment that I have on the farm, that would actually be a positive cash flow in the investment side. And then the final cash flow section is the cash flow from financing. So if you're getting started in a farm business, chances are you probably have an off-farm job, which means you have the ability to put money into your farming operation. And then one day when your farm is greatly successful, you're going to pull money out of it for your own personal use. And that's what we're talking about when we're doing financing. So traditionally, it is going to look like buying stock from your farm by putting money into it and getting paid from your farm later on whenever you take money out of it, and that's your cash flow from financing specifically. So you can see how our cash flow from operating is our normal business. Our cash flow from investing is not going to be a regular thing because we're not always going to be selling and buying the same amount of a tractor or other piece of equipment every single year. And then our cash flow from financing is going to be us putting money in and taking money out of our farming operation. So here's a good example of why keeping track of your cash flow is important. So on the left, we see a farm that has made a net positive profit in the year, and on the right we see a farm that has made a net negative profit during the year. So you can see the revenue on the right is $61,000, and that farm had $58,000 of expenses that year. So they had a net profit of $3,000. They made money for their farm. However, they did sell a little bit of equipment in the amount of $4,000, but they had to make so many principal payments that they had an amount of $9,000 going towards the purchase of their assets, so that they had a net negative cash from buying and selling capital of $5,000. Well, when you put those two numbers together, the bank account for the year went down by $2,000. So even though we made money, we had a profit, our bank account went down. And so we would need to be able to plan for that and know what exactly that looks like as far as paying our bills, or else we might have to take on more from our operating line of credit, which is more interest payments. And on the right, you can see again, we had a revenue of $61,000, but this time we had expenses of $65,000. So that we actually had a negative profit of $4,000 for that year. However, we sold one of our tractors, so we brought in $15,000 that year, and we had principal payments of exactly the same as the previous example of $9,000. So we actually netted selling and buying capital of $6,000. So if we just looked at our bank account, it would look like we did pretty well that year. The amount of cash that we had in our farm checking account went up by $2,000. Seems like we're doing fairly well, but if you didn't keep track of the records and knowing how much profit you actually made in that year, you might not realize that there might actually need to be some changes made for that farm. And so next year, whenever you don't have that $15,000 tractor to sell because you sold it last year, and you have a negative $4,000 profit again, plus a loss of $9,000 from selling capital, you're going to wonder what happened. And having these records can tell you what exactly that picture looked like for the year. So some years it's perfectly okay and it's perfectly normal for a starting business to have negative profit. But if you did have that positive increase in your bank account, you would need to know why so that you can plan for the future. So for this next section, we're going to take all of the record keeping that we had and we're going to put it together and what exactly it means to develop an enterprise budget for the upcoming year. So over the past year, we did a really good job with our record keeping system. We were able to create a balance sheet, our profit and loss statement, or our income statement, and our statement of cash flow. So how do we use that information to plan for the upcoming year? And I have a QR code here on this slide, so you actually can go and look at the University of Tennessee's budgets and find one that fits your operation. Or if you don't, you can search out there for other university enterprise budgets or reach out to me and I can send one to you that directly fits what enterprise you're trying to get into. So whenever we're developing an enterprise budget for our farm, we're going to be looking at three distinct sections of it. And so the first one is the one that you hope that happens at the end of the year in a really positive form, right? So we want to sell a lot of product and bring in a lot of revenue. And so this is going to be the small section of our enterprise budget. We look at the variety we're planting or how many livestock we have, and we can kind of estimate how many sales we'll have, at what price, and how much money we're going to bring in. The second one is going to be directly related to how much we are producing, and that's going to be our variable costs. So whenever we're talking about variable costs, we're talking about expenses that are directly related to our production. So the more we produce, the higher our variable costs are going to be. The less we produce, the less our variable costs are going to be. And a good example to conceptualize that is going to be feed expense. If I have 10 head of cattle, I'm going to be spending a lot less on feed than if I had 20 head of cattle. and it's going to be relatively directly proportioned to the number of cattle I have, right? Roughly 20 head of cattle are going to eat twice as much feed as 10 head of cattle. And that's all variable expenses are, is that those directly tied expenses, so that we know where each unit more that we produce is going to increase that. And so it is very important to make sure for our future level of profitability that we are bringing in more revenue than we are spending out in variable costs. Because if we have a negative profit over our variable costs, well, then the more we produce, the more money we're going to lose. But once you get to the point to where you are making money over your variable costs, then we can look at the next section of spending called our fixed costs and see how much we need to produce in order to make a profit. So what I mean when I'm talking about fixed costs are going to be those expenses that remain relatively steady year to year. So an advertising budget can be an example of that. Chances are that will remain relatively steady. Maybe increasing costs can affect it, but if you produce 100 bushels of corn or 5 bushels of corn, the amount that it costs to advertise, say, on Facebook is going to remain relatively steady. Our principal payments and interest payments on our farm loans, so the total number of payments we're making out on loans, those are going to remain relatively steady, barring taking on new debt, right? So it doesn't matter how much we're producing, we still owe the exact same amount to the bank each month or each year. And there's going to be a few other things like that, right? So fuel expenses can remain relatively steady. Buying something like storage is going to remain relatively steady. Utility usage, all of these things can change slightly with production, but it'll remain relatively baseline from one year to the next. So with those two pieces of information, here is an example of how to put this all together so that you can know what to charge for your products in order to get the return that you need. So if we take our variable expenses plus our fixed expenses and divide those out by how much we are producing, we can actually figure out how much we should be charging for the amount that we're producing on the farm. So in this example specifically, using the budget that we just looked at, we had $503.79 of variable expenses and $686.90 of variable expenses. We expect to produce 450 pounds worth of tomatoes in the calendar year. So adding those two costs together, dividing out by how many pounds we expect to not just produce, but also to sell, we can figure that we need to receive at least $2.65 per pound of tomatoes. And you can do this in any type of production you like. Here I'm using an example of 450 pounds, but you can do this as bushels. You can do this on a per tomato basis for this example, or any other way that you're wanting to. But in this case, we need $2.65 per pound of tomatoes produced in order to just make our money back for that year. So if we want to make a profit for the year, we need to add in a little bit extra from there. But we need to average this amount to break even on that year. So let's take that and let's shock it for our planning purposes just a little bit. Imagine that our variable expenses increased by 10% for that year to $554 for the year. Well, if we increase our variable expense, add it to the exact same fixed expense, divide about by the exact amount of steel production. So imagine that fertilizer prices increased in this example. We see that 10% increase actually increased our price per pound to $2.76 per pound. Whereas in another example, if you were to lose 20% of your production, but your costs remained the same, we actually see an increase even more of how much our break-even costs can. And this is another thing that I talk through a lot, is that you are going to have a hard time controlling how much it costs for the things that you need for your production. But through correct production practices, the number one thing that you can control and do for your farming operation is to make sure that you are receiving the quantity of production that you expect. And that's the best thing that you can do for your bottom line and the best thing that you can do for break-even production on your farm. All right, I just want to touch real quickly on what exactly you can do to protect yourself in your farming operation. So there's a few options out there for insurance that is going to depend on what you're producing. So if you're someone that's producing small fruit and vegetables, then there is this whole farm revenue protection plan or micro farm revenue protection plan. So after you have 3 years of records, like I said, record keeping is very, very important. You can actually go and try to purchase some insurance for your farm. So keep good production records, because how much you produce each year on that farm is going to say how much insurance you can actually take out onto your farm. Whereas if you're producing livestock, so let's use for this example cattle, you can actually go and purchase what's called livestock revenue protection plans out there. And that is where, unlike on some other insurances out there where you actually are protecting yourself against loss, with livestock revenue protection or LRP insurance, you are actually buying a price for your cattle. And if you have any questions about this specifically, please feel free to reach out to me for my contact information listed somewhere around this presentation. So with these two examples, I am not talking about protecting yourself against liability. That is where you're going to want to have some type of umbrella policy, have an entity formation laid out correctly, and things like this. With this, I'm talking about just specifically protecting the revenue for your farm against things that can be very unpredictable, like drought or price drops in the commodity markets. Just real quickly, I want to talk about a few different record-keeping softwares out there that you might find interesting. So the first one is going to be called Quicken. This is not QuickBooks, but Quicken, Quick-E-N. And whereas something like QuickBooks can run you $90 a month, something with like Quicken, we're actually looking more about the $5 to $10 a month mark. And this is something where, just like we talked about earlier about what exactly needs to be included in your record keeping system, you can connect it directly to your farm bank account and then see them loaded into your Quicken file, see the date that that transaction happened, list out who the payee was, how much exactly was paid for that. And then the most important two things is going to be assign it a category. So what exactly the expense was, examples being something like feed, seed, fertilizer, and then what enterprise it was attached to. So on the screen you can see a tag listed there, and more specifically a cow-calf enterprise. So if you're running a multi-enterprise farm, you're going to want to have these separated between your enterprises, and then you're also going to have a section called overhead. So these are going to be the things that you can't do enterprise specific. I don't know how much fertilizer went to the tomatoes versus to the squash. And at the end of the year, or even throughout the year, you can actually run a full report that says exactly how much you spent on each spending category and how much money you brought in per revenue category, all to equal up to your profit or even your positive or negative cash flow for that year. But don't think that you need to purchase any type of record-keeping software to keep good records on your farm. Something as simple as Excel, which I know has a purchase price, or even Google Sheets, which you can access for free online, can be perfectly acceptable, if not just a little bit more in depth in order to keep good records. So I have here on the screen an example of the exact records that were in the previous Quicken example, but listed out in an Excel file. And you can use these to run very similar reports once you get everything set up and become a little bit savvy in using these record-keeping softwares or just softwares in general. So it's a little bit more of a learning curve, and it's a little bit more in-depth and a little bit more time-consuming, but you can get just as good records out of it by using some of these free or cheap softwares out there. So you maybe even start out with those before you move to more in-depth or even paid subscription services. So just to touch on a couple of other record-keeping systems real quick, QuickBooks is fantastic for a giant and varied farm. So someone that is going to have a lot of sales every day or every week, and someone that's going to have a lot of invoicing and a lot of billing. But if you are not that farm right now, even if you strive to be one day, this can be a very cost prohibitive program to get a hold of. Really what you're looking at is about $90 a month versus something like Google Sheets that is free, or something like Quicken that is $5 to $10 a month. And then another one that has kind of appeared on the scene within the past couple of years, and I've gotten a few questions about, is Ambrook Research Record Keeping. And so with this record keeping system, it is still quite a bit pricier at about $35 a month. than some of the cheaper record keeping systems, but is tailored specifically towards farms. So you log in and it already has categories labeled for farming operations. So it might be a comfortable way to move into record keeping system, but again, it can be a little bit pricier. And since they are relatively new, I don't know all of the intricacies or where they might be improving on a day-to-day basis. So I know that everything I just talked about seems like a lot, and it is, and it's hard to implement, and it's not the reason that you started a small farm business. But just know that there are resources out there to help you fit into that. Myself, RC&D, and plenty of other places out there that want to help you be successful, not just out in the field, but in your records and actually doing profitability. So just know that wherever you start is a good place to start building upon your record keeping ability, your financial statement creation, and you're not the only one struggling with that. Talk to other producers and ask them how they're doing. Reach out to the free resources that are available to you and play with it. Be willing to mess up a couple of times in these concepts before you figure out what really works for you, because it's going to be different than everybody else. With that, again, feel free to reach out to me with any questions that you have. University of Tennessee Extension is a resource that is provided for free to you to figure out all the things we talked about today and more. And you can see my contact information there. And good luck with your small farm business.